uh, our moderator Amol Sinha ji, and our all the colleague of the CTC Bombay, and ladies and gentlemen here. It is my privilege on behalf of the Chamber of Tax Consultants Delhi chapter to present something which is very interesting to all here. And this is the continuation of our that efforts that we try to do here. Last week, we had done some very good webinar on the issue of the GAR versus MLI that was well recognized by every corner and every professional. This time, we are trying to recapitulate whatever the judgment that has been pronounced by the Honorable Supreme Court on the subject of income tax matters here. So it is our annual ritual that we try to cover the judgments that has been pronounced in the calendar year, particularly calendar year, because now the Supreme Court is closed. We are going to be in 2026 in a couple of days. And before we start our Christmas celebration, before we start our holidays, before we go for the New Year celebration, I think that it is a good time that we should recapitulate all the judgment what has transpired in the last year here. With this, may I request Jayant Gokhale sir to to speak about the Chamber of Tax Consultant, and after that I will request Dipesh Bora sir to give some few words about the study cycle, in the study group meetings also. Gokhale sir.
Thank you, Sanaji. A very good afternoon to Sri G.S. Pannu, Mr. Sriram, Mr. Jain, other office bearers of the Chamber of Tax Consultants, as well as the Delhi chapter and the others organization aligning with us. Thank you very much for giving me this opportunity, more because it is a pleasure to introduce. Very briefly, I know that all of you are looking to the main content, so I will be very brief in just mentioning that Chamber is celebrating its 100th year of existence. And I would only mention that an organization like this, a not-for-profit organization, survives this long only because it is driven by two factors. One is selfless service, which you will find exemplified by all our active members who are here, that it is for the wider objective of propagation of knowledge, spread of knowledge, that we make every attempt. And as a byproduct, one can say that the increase in professionalism, the increase in awareness, which enables us to give better service to our clients, and even more important, satisfies our own conscience that yes, we are doing our best for whatever we are supposed to do. So I would only say that Chamber has been very active in this. We are celebrating our 100th year. We are bringing out some special programs. We are also in the process of elevating. You have seen how well Delhi chapter has been functioning. We are elevating that to the status of a branch shortly. I am in consultation with Mr. Sinha because we need to actually see that enthusiastic people like this are suitably recognized in the overall hierarchy. And I'm just one of the beneficiaries who have been recognized as a president for this momentous year. I am hoping that all of you are in the process of going up the ladder and reaching your own eminent status in due course. And I look forward to that. I would only mention that it is not just those whom you are seeing here, but every person who is practicing at the grassroots level, whom we hope that you will be, that awareness created in you will enable you to be enormously successful. We are there to facilitate your success. We are there to promote it. I wish each one of you, if not already a member, be an active member. If you're already a member, become a more active member and take part in these discussions, deliberations, because there is nothing more educating than being a part of such panel or part of deliberations. So with these few words, our study circle activity carried on by Laura in a big way. I think if Sinaji agrees, I think we can pass on the baton to Dipesh ji, or in accordance with your...
Yes, sir.
Yes, Dipesh ji, I think you can give more specific inputs so far as the study circle is concerned. And I thank all of you for bearing me out on this wonderful occasion.
Thank you, sir. Thank you for your blessings, sir, and thank you for gracious presence here, sir. May I request Deepesh Bora, sir, to speak about something about the study circle and study group meeting that we try to do every week in Bombay here, sir.
Uh, Thank you, Prakash ji. Very good evening to everyone. Respected Pannu sir, all the panelists and the audience. Uh, as chambers, it is a privilege to be associated with a chamber, which is now in its 100th year. It is study circle and study group committee, which I'm happy to share that one of the speaker, Mr. Sriram, as well as Prakash Sinha ji, both are the members of our committee. So as it's a joint, Prakash Sinha ji today is in a dual role because since it's a joint program, he is a part of the committee also in study circle study group as well as he looks after the Delhi chapter. So study circle and study group is one of the oldest committee. We do program on direct taxes, and the difference is that we do physical programs. I mean, almost 90% of the programs which we do are hybrid. And I'm happy to share that this year Chamber has renovated its Mumbai office, and one particular premise is entirely converted to an auditorium with state of the art facilities, and which are useful in a very big way to the meetings which we are conducting. So in study circle and study circle we discuss about income tax recent topics, and in study group we have a every month or maybe one and a half month we discuss on Supreme Court and High Court judgments, and I'm happy to share that eminent tax senior professionals are gracing all our meetings, and I encourage everyone to be a part of study circle study group as well as Delhi chapter, whatever the knowledge is the one thing which will never which we can is available throughout our life, and avail benefit of the programs which we are undertaking. With this, I would now request Prakash ji to take it forward.
Thank you. Thank you, Deepesh ji. Briefing about the study group and study circle meeting that takes place. It is a dedicated group where we discussed about the topics of the income tax and various things here. Before we proceed here, it will be may I request our colleague Richa ma'am to read the profile of the chairs and the learned speakers and the moderators also.
Thank you very much, Prakashji. Good afternoon, everyone. We are honored to have with us Mr. G.S. Pannu, former Vice President and officiating President of the ITAT. He served the tribunal for over 2 decades, including 18 years as accountant member and 6 years as Vice President. Renowned for his judicial and administrative leadership, he brings unparalleled depth of experience in tax adjudication. Very warm welcome, sir. We would also like to welcome Mr. Gaurav Jain, who is a chartered accountant and advocate with over 20 years of experience in direct tax litigation and advisory. He regularly appears before various appellate authority with core expertise in international tax, PMLA, and black money law. Very warm welcome, Gaurav ji. We would also like to welcome Mr. Sriram, who is an advocate and practicing before the Bombay High Court and various tax tribunal, and is also a chartered accountant by qualification. He is currently an executive partner at LKS Sridhar and Advocates and have 15 years of experience in domestic and international tax law. Welcome, Sriramji. We also have with us Mr. Amol Sinha, who is an advocate and currently the standing counsel of GNSTD before the Delhi High Court. He has earlier served as a senior standing counsel for the Income Tax Department and brings with him rich experience in tax and constitutional litigation. Welcome, everyone. Over to you, Pannu sir.
Now the dais is with Pannu sir.
Thank you, Richard. Thank you, Prakash. I would only like to make just 30 seconds of opening remarks before we let the speakers take their go. Mr. Jain Gokhale, the president of the chamber, and also Dipesh, who also spoke about the chamber, the office bearer of the study group. very rightly put it that it is very rare to find these institutions for 100 years almost, which have been doing service in this sector of the society. And apart from being beneficial to the tax professionals, the advocates at large, the taxpayers at large, also the tax authorities, you see what also it contributes to society in my mind is establishing and giving finesse to the rule of law, which is so essential for a country like ours. And especially such a diversified country, we have multiple high courts, multiple tribunals, and multifarious authorities all around, and the laws are overlapping at times. So providing such a forum, and that also have been doing it for last 800 years, it's commendable. And with that, the kind of integrity with this chamber carries with it, it is remarkable. I was a witness to it. I was posted in Bombay for almost 5 to 7 years, that I could see this side of their institution. Kudos to them and all the very best. And I'm sure today also, with the kind of effort which has gone into the selection of the topics and the what behind the scene effort made by Sriram and Gaurav and also Amol Sinha, I'm sure with the indulgences of Prakash Sinha, who is almost like he works non-stop, it seems, every day on putting people into getting into the nitty-gritty of the things. I think we are going to have a very good session. So I would now like to go to the first speaker. I think who's doing the first one? Let's see.
I'm
Gaurav is doing
it.
Gaurav, sir.
American Express. So
Yes.
you can start, Gaurav, I thought.
Yes. Prakashji, can you put on the slides?
Just hold on, sir.
Yeah.
Just hold on.
So friends, good evening. I think it's indeed a pleasure to be part of the chambers, and considering such a deep history of good work being done by chambers, it's indeed my pleasure. And I hope that the session will come out to be successful. We are going to learn from each other about the nuances of important judgments from the Supreme Court. So what I and Shriram has done is prepared slides for 6 detailed judgments, which we will be taking through by first discussing the facts of the case, what was the issue involved, and what ultimately was the ratio of that judgment. So with this background,
it is coming,
yeah.
Gauravji?
Yes, I can see that.
Yes, it's.
So friends, the first decision I think which we are discussing is the decision, an important decision having far-reaching implications in the case of American Express. I think the issue that we will be discussing in this case is the interpretation of Section 44C, which seals the limit for allowability of expenses incurred by head office of a foreign company while claiming deduction against the business income of a non-resident in India. So in this case, friend, as per the facts, the assessee was a foreign bank, that is American Express Bank, which was also carrying on banking business in India through its branches. While filing the return of income, it claimed deduction for certain expenses incurred by the head office, that is the foreign company, and the claim of the assessee was that these expenses were exclusively related to India branch. And therefore, since it was exclusively related, it is outside the ambit of Section 44C and should be allowed 100% under Section 37(1) in the hands of the profits of the foreign branch in India. Why the assessee did not want it to apply 44C was that 44C restricts the allowability of expenditure incurred by head office, that is head office expenditure, to 5% of the adjusted total income of a particular year. There was a background of that adjustment, which we will discuss as we move forward. The question, Prakashji, you can move on the slide. So the argument of the assessee has all along been that when we see Section 44C, which was in the previous slide, it talks about the expenditure, head office expenditure attributable to India. So the argument of the assessee was, by use of the word attributable, it is only the common expenditure, that is, some expense must relate to foreign business of the non-resident and some expense must relate to India business of the non-resident, and only such common expense which is to the extent attributable to India business is covered by 44C. So the question before the Supreme Court, the High Courts were in favor of the assessee. The matter was taken by the revenue before the Supreme Court, and the question was whether the head office expenditure would only include common expenditure or would exclude exclusive expenses incurred by the head office in relation to India. Unfortunately, the Supreme Court has reversed the decisions of High Court and held that no, the head office expenditure is not restricted to common expenditure. Even exclusive expenditure will be covered within the scope of that section. Prakashji, can you just come back to the previous slide? The basis, the Supreme Court, it's a very elaborate judgment. While going to the judgment, not only the Supreme Court has interpreted Section 44C, but reiterated the principles of interpretation which led to this conclusion. The first principle that the Honorable Supreme Court first emphasized and then applied to Section 44C was the principle of literal interpretation. So they held that while literally interpreting Section 44C, which is plain and unambiguous, one cannot read the common expenditure to be covered within the scope of Section 44C. So they held as per the findings in the second bullet, on plain reading of Section 44C, there is no condition of head office expenditure to be common or excludes exclusive expenses from the scope of the said section. No words can be added to the statutes that simply do not exist, at para 48 of the judgment. So first they applied the principle of literal interpretation to hold that we cannot include common expenses within the meaning of head office expenditure. The second, they went on to interpret the word attributable to, and they have devoted several paragraphs while interpreting the meaning of the word attributable to. They held that the word attributable to is wide enough, falls in the category of a genus to include even exclusive expenditure, which is a smaller category, is like a species of the genus. So therefore, the word attributable to would also include exclusive expenses incurred by the head office even in relation to India. And therefore attributable to will cover both common expenses as well as exclusive expenses, being the larger genus of the word attributable to. That's the second finding from the Supreme Court decision. Now next slide, Prakashji. Then not only the literal interpretation, they also applied the principle of interpretation of purposive intent, and they went on to read the legislative intent as could be gathered from the memorandum and the CBDT circular at the time of insertion of the provision. They held that the reason behind the aforesaid insertion was that foreign books are unverifiable. Whether the expense incurred by the head office is inflated or not, Indian authorities are not in a position to verify it. So therefore, that was the reason that the legislature intended to cap the allowability of head office expenditure, and there was no reason to restrict it to allowance only to common expenses or to exclude exclusive expenses. Therefore, on both literal interpretation and purposive interpretation of Section 44C, the Supreme Court held that attributable to would cover both common and exclusive expenses. The third important principle that emanated from the said decision is that they upheld the very old decision of Calcutta High Court in the case of Rupanjali Tea Company, which was generally being followed by the High Courts to hold, while upholding that common expenses are only included in 44C and excludes exclusive expenses. The Supreme Court first upheld the ratio of the Calcutta High Court and then distinguished it from the facts of the present case and other High Court decision on the ground that in this decision of Rupanjali, the assessee, the foreign company, was only doing business in India and there was no business outside India. It was only an administrative office located outside India, and therefore even if in such a situation where no business is carried outside India, the exclusive expense incurred by head office will be fully allowable under 37(1) without any restriction of 44C. They said that when the business is carried on only in India, then the clause C of section 44C, which uses the word attributable to, fails, because attributable to would involve business being carried out by the foreign company partly in India and partly outside India. Since there is no business carried out outside India, the clause C of 44C fails, and they applied the ratio of decision of Supreme Court in BC Srinivas Shetty, which was although in the context of capital gains, to section 44C also, that if the computation mechanism fails, the charging provision fails. So if clause C is not workable, we cannot rope in 44C. So this decision has been upheld by the Supreme Court in the present case, but distinguished on the ground that ratio of Calcutta High Court will apply only to cases where there is exclusive business related to India without any business carried outside India. Next slide, Prakash ji. So accordingly, they held that the earlier decision of Bombay High Court in Emirates Commercial, which was in fact approved by the Supreme Court and was relied heavily by the assessees to say that earlier Supreme Court has already upheld the proposition of exclusive expenses, was overturned, holding that the earlier decision of Bombay High Court approved by Supreme Court did not went into detail in examining the provisions of section 44C, the meaning of words attributable to, etc., and had simply followed Calcutta High Court in Ripanjali, which is distinguishable. They do not hold a binding precedent. So that this is how they upheld they laid down the interpretation of section 44C. Prakash ji, previous slide once again. Previous slide. So lastly, there is something positive also which has emanated from the aforesaid decision, is that they held that the nature of expenses specified in section 44C are exhaustive and not inclusive. The argument of the revenue on this issue was that every head office expenditure incurred will be covered by 44C and therefore will be capped or will be subject to ceiling under that section. The Supreme Court, however, held, next slide. So if we'll see the meaning of the word head office expenditure as defined in section 44C, first it starts with head office expenditure means executive and general administrative expenses. So by the use of the word means, there is an exhaustion, there is a restrictiveness incurred by the assessee outside India, including expenditure incurred in respect of expenses specified in ABCD, that is rents, rates, taxes, repairs, salary, wages, etc., traveling expenses, and last but not the least, such other matters as may be prescribed. So because of the word used, including, the revenue was arguing that this is an inclusive definition, and therefore any expense incurred outside India by the head office will be considered as a head office expenditure subject to ceiling under 44C, which has been reversed by the Supreme Court, which has been rejected by the Supreme Court, saying no, it's exhaustive. Because if it is not to be considered as exhaustive, then the last clause D, which says that such matters as may be prescribed by the government will become OTOs. So therefore, the intention of the legislature is to restrict the nature of expenses. So this is a positive finding which has emanated from the aforesaid decision, which according to me, although the first part has been decided against, but this issue also has far ramifications, because many expenses which are incurred by the head office will now not be subject to ceiling, that can be claimed as deduction under section 37(1), and only the smaller category of expenses specified in ABCD will now only be subject to 44C. So this is, friends, the entire decision of Supreme Court. And if just to summarize, there are many important fallouts from the said decision. First, certainly, is the scope of section 44C, which is partly against the assessees. But the other important fallouts are the reiteration of the principles of interpretation of fiscal statute, that is the literal interpretation along with the purposive interpretation. the restricted meaning of head office expenditure, meaning of the word attributable to, and last but not the least, the upholding of the finding of Calcutta High Court in Ripanjali Tea Company, that where the computation mechanism fails, charging provision also fails. This proposition is generally as assessees we relate to capital gain provisions, but that has even been applied to a deduction provision. So these are 4 or 5 important implications from the aforesaid decision. With this, now I hand over the baton to our honorable chairman, sir, to kindly give his remarks and maybe invite comments from my co-panelist.
Anmol, you wanted to do some. You want to say something on this because
yeah.
Anmol, you have some view on this?
Sir, I'd request you to kindly, give your thoughts on the judgment, and then maybe we'll pass on the baton to Sri Ramji.
Okay, for the next judgment then. Sriram,
yes. Yes.
No, you see, Gaurav has very elaborately pointed out. So, see, first of all, seemingly, perhaps upset the Bombay High Court judgment, which had all along been on the principle that 44C does not govern the direct expenditure which has been incurred as a head office expenditure. So it is confined only to an expenditure which is of attributable nature, meaning it is not exclusively for the head office, exclusively for the Indian branch, but it confines only to something which is commonly to Indian branch as also the non-Indian business operations. So that is, of course, I think as a student of law, what comes out from the judgment is, one is they have explained as to which interpretation theory to use at what stage. You see, and one important takeaway, what they're saying is that wherever the words in plain and unambiguous of any provision, one need not then go to the legislative intent. That's very important. They say that reference to the object and purpose becomes crucial only in those situations where the language is ambiguous and capable of multiple constructions. And yet, they went into, and as Gaurav read out, that they also went into the fact as to why this, under which background and what purpose and object this provision has been brought in 44C. Rather, they have said that 44C was a provision to, make things easy for the taxpayers also. Because obviously, when the Indian tax authorities are assessing an expenditure which is incurred, and there is one must not forget that the section is confined to the expenditure incurred outside India, incurred by the assessee outside India. So therefore, there could be an aspects of unverifiable nature which may be difficult for the assessee to bring forth before the Indian tax authorities concerning books of account which are contained outside India. So in fact, that was one of the reasons for the introduction of this section. And also to reduce litigation, that the assessing officer also would not be in a position to verify, which may lead to inflated expenditures, inflated claims. That is the purpose, which they have used to support their interpretation of the language used in the section. So therefore, that is first important thing. And the second important thing which probably comes out is, as Gaurav rightly pointed out, so the Calcutta High Court theory has not been done away with, because there the High Court found, as a matter of fact, that the expenditure was not incurred by the assessee outside India, because the head office, so-called head office in London or Dubai, perhaps London, I think. So that was something which was only for the namesake, in the sense that all the activities are being carried out in India and were incurred in India. So therefore, they said that because of the definition of head office expenditure, one of the clauses failed to operate in the computation provisions. So therefore, they went back to the general proposition of the Supreme Court to say that whenever the computation mechanism fails, the charge has to fail. So that proposition remains on those facts, and that fact that has not been disturbed. Other aspect also is the fact that which the revenue pleaded before the Supreme Court, and impliedly that has not been negated, that a case where expenditure incurred outside India and head office expenditure which may be falling in that nature, which is reimbursed by the Indian branch, would still not be under the 44C limitation. Because that is how they distinguish one of the judgments. These two, and of course, the third aspect by Gaurav saying that the definition has to be applied, which is the exhaustive definition. It cannot be taken to be inclusive definition. And that's one aspect which is in favor of the taxpayer. But yes, they have gone by the meaning of the word, what is to be understood as exclusive and what is to be understood as what is meant for attributable. To my mind, perhaps the lower courts or the courts before this judgment were reading too much into the presence of the word attributable in the section. That's why perhaps this controversy, but anyway, it is finally settled now. And that's how we have to manage the tax affairs for our clients accordingly. If questions are there, we can do it put it in the chat box. We can perhaps do it, take it at the end. We can go to the next, I think, judgment now. I think Mr. Sriram is to take that.
Yes, so Mr. Sriram will take that, sir. Please, Sriramji, over to you.
Thank you, sir.
Shall I change this one?
Yes.
Yes. Jupiter Capital, sir?
Yeah.
Yes. Yeah. The judgment that I want to discuss relates to what would happen in the case of loss arising in buyback of shares. The situation ordinarily does not arise in any case of buyback. These are unique situations. But I went and studied for this judgment. I found there was a judgment of special bench of the tribunal in 2011, which has effectively been overruled by the Supreme Court now, and the judgment of the Gujarat High Court on similar points, which has been approved by the Supreme Court. Before going into the facts of the case, I would slightly want to go 60-70 years back on taxation of income arising from capital reduction as it was then known. As you all know, the concept or the nomenclature of buyback was introduced in the Companies Act as well as in the Income Tax Act only by the Finance Act 1998. Till then, all the transactions of this nature were covered within the larger scheme of the Companies Act, which was given a common name of capital reduction. That is, and also commercially as understood by promoters and shareholders, where a company has excess capital and reserves, which it does not need for future, it is returned to the shareholders by reducing the capital of the company. In a few instances where the company has incurred significant losses, then the capital of the shareholders is used to adjust said losses by reducing the capital of the company and adjusting the losses also correspondingly. When capital reduction happened prior to 1939, that is, there was no definition for dividend in 1939 till 1939, and capital gains were also not liable to tax. Whenever capital reduction happened, assessees argued that the money that they received from the company on reduction of capital is nothing but a return of their capital and therefore not liable to tax. It is not liable to tax as dividend because it is in the nature of returning the capital which the shareholder has initially invested. It is not taxable as capital gains because there was no charging provision for taxing capital gains till 1954. Mr. Paul's book on British income tax in 1940 quotes around 6 or 7 judgments that are dealt with similar fact situation both in India, Rangoon, and British controlled territories, where it has been a regular scheme for companies to offer a buyback scheme for the shareholders and return the capital and reserves. The House of Lords has held that this is capital receipt not taxable in the hands of the shareholders. To overcome this, a definition was dividend was introduced pursuant to the recommendation of the Select Committee in 1936 by the Finance Act of 1939. Clause B of the definition of dividend, as it today stands also in 222, said any money received by a shareholder which is equivalent to the reserves of the company pursuant to a buyback of shares or capital reduction will be treated as dividend in the hands of the shareholder and dividend only. This is to overcome the judgments of the House of Lords prior to 1939. So post 1939, whenever money is received by the shareholder on buyback, it was taxable as dividend. The question of loss arising in the transaction did not materialize because a loss arising on capital was anyway a dead loss prior to 1954. So between 1913 and 1954, the dividend was taxed in the hands of the shareholder to the extent of the reserves. Over and above the reserves, it was considered as a capital receipt. Loss was in any case not allowed as a deduction. Post 1954, when capital gain was introduced, there was no change to the definition of dividend. To the extent of reserves, it was taxable as dividend. And as observed by the Supreme Court in Punjab distilleries, any money returned to the shareholder over and above the amount of reserves the company has will be taxable on the hit capital gains. What happened to losses was not very clear. By Finance Act 1999 with effect from 2000, a deeming fiction in the form of 46A was introduced in the Income Tax Act, which provided for taxation of such capital gains. The wordings of the section, which is a deeming fiction, are very interesting. It says, where a shareholder receives any consideration on buyback, then the value of the consideration as reduced by the cost will be deemed as capital gains. I repeat, the section as it plainly reads says, where a shareholder receives a consideration on buyback, then the difference between the cost and the consideration received shall be subject to tax as capital gains. This section again does not deal with what will happen on loss arising, and is confined, interestingly, to a situation where consideration is received. What will happen if in a buyback no consideration is received by a shareholder has been a subject matter of dispute for a few years in the recent past. The special bench of the Bombay Tribunal, by a 2-1 majority, by a minor majority, 2-1 majority, held that when no consideration is received on buyback, Section 46A might not apply, and therefore the loss is a dead loss. To the contrary, the Gujarat High Court, in the case of Jaikrishna Harivalabh Das, held that zero consideration is also consideration, and that the section will apply even when no consideration is. There are two conflicting judgments in that point. This is how the law had developed till the matter, in this case, went to the Supreme Court. Before the Supreme Court, the facts were slightly easy to follow. Just a minute. The assessee was a shareholder in an Indian company. Over a period of time, it had acquired at stages shares in the company. At some point, was holding around 99.88% shares in the company. The investment was made in Asianet News Network. Due to many foreign news channels opening up their office in India, Asianet had incurred significant losses. to reduce the losses and adjust it against the capital of the shareholder, a scheme was proposed before the Bombay High Court for capital reduction. The High Court approved the capital reduction. The shareholder continued to hold 99.88% shares in the company. There is a proportional capital reduction of the number of shares. Shares were cancelled. The High Court also directed the company to return around 3 crores as a consideration for the buyback of shares. The assessee offered the difference between 3.27 crores and the cost that he had incurred to purchase the number of shares cancelled as loss arising under the head capital gain and sought it to set off against other capital gains. The assessing officer disallowed the set off on the ground that prior to the buyback also, the assessee was holding 99.88% of the shares. Post the buyback also, the assessee is holding 99.88% of the shares. So effectively, the shareholder has not transferred anything. He controlled 99.88% of the shares of the company pre-buyback and post-buyback also. And therefore, in the absence of a transfer, the loss which is computed by the assessee cannot be allowed to be set off, is what the assessing officer held. When the matter traveled to the tribunal and the High Court, various other arguments were taken by the revenue. But finally, the Supreme Court held that reduction of share capital, whether the shareholding continues to be at the same percentage or at lower, effectively amounts to transfer in the eyes of Income Tax Act. We need not see what is the control of the shareholder in the company. The asset for the purpose of income tax is a share. The assessee has renounced his right in the share, and following a series of judgments, Anarkali Saraba, etc., the Supreme Court held there is in fact a transfer by the assessee of his shares, and therefore the loss arising therefrom will be allowed to be set off. The Supreme Court considered the other view also, other argument of the revenue also, that even in a situation when no consideration is arising pursuant to the buyback of shares, the computation mechanism does not fail. The consideration should be considered as zero and the loss to be computed considering the consideration as zero. While holding so, the Supreme Court expressly quotes and approves Jayakrishna Hariwallabh Das of the Gujarat High Court. Even when consideration is zero, the provisions relating to 46A are attracted, and then the loss shall be allowed to be carried forward and set off. This judgment effectively overrules the special bench judgment of the Bombay High Court. This is all I wanted to highlight, and then leave it to the panelists for their comments and inputs, please.
Pannu sir, I'd request you to give your thoughts on the judgment which is there.
I think C.S. Sriram has, he has covered all the points. The background of the law has it, how it develops. Essentially, as we see, it is essentially a ruling on how to interpret the expression transfer in the context of relinquishment or extinguishment of rights in 247. And it is more or less a settled proposition emerging from the Gujarat High Court. Yes, he has brought to the fore one special bench judgment of the tribunal, which obviously because of the Gujarat High Court was a bit eclipsed. But anyway, now with the High Court being, impliedly approved by the Honorable Supreme Court, so that does not no longer hold good. But another aspect is which more of a question. In Sarabhai and all, I think if I'm not wrong, it was a case of preference shares.
Yes, sir.
And in the present, I think they deal with equity shares, or they're also dealing with
Equity shares.
The equity shares here, no?
Equity
I
shares.
think that is one another aspect, because that it is not emerging very clearly, except from one line in the beginning when they talk about the Bombay High Court's approval to their reduction scheme.
Yes, sir.
So therefore they have, so in the context of having the voting rights also, they have answered the question that
Yes,
even the proportion of voting right remaining the same will not be determinative of once the number of shares have been, there is a reduction in the number of shares. And in any case, in this matter, there was a consideration of cash also coming in. Part of the consideration was received in cash. So anyway, they need not have gone to the divergence between that Bombay special bench of the tribunal and the Gujarat High Court, but they have answered that point also. You have absolutely very rightly pointed out. If any questions we have, I think we can take it later, but you have summed it up appropriately.
Panu sir, can I come in? I have one observation on this decision.
Yes, why not?
I think, sir, to my mind, the most important observation which can have far-reaching implication is the approval of Gujarat High Court in J. Krishna that even if consideration is not received, the transfer provisions or the computation provisions can apply. True. I would like to extend this proposition to cases which can have far-reaching implications like deeming provisions of Section 50C, 50CA for immovable property and shares. So when we see those deeming fiction provisions, they also start with word where the consideration is received or accruing. So let's see 50CA for a minute. It says where the consideration received or accruing as a result of the transfer by necessity of a capital asset being unquoted share. If the actual consideration is less than fair market value, then the fair market value shall be deemed to be the consideration. Now, since this is a Supreme Court decision approving Gujarat High Court, if I have transferred a share, let us say, which is not by way of a gift, a company transferring a share without consideration, then this 50CA, one can argue, that will be attracted, and the transfer will be subject to deeming fiction of fair market value under 50CA, and we can extrapolate it to any other deeming provision.
Well, yes, there is a threat. I appreciate, but then we have to look at it for what purpose are they saying so? No? This is primarily they said so for the computation purposes.
Right.
So we'll see, but you have a point. This can be threat. More on that. If you extend that logic, see, there can be some restructurings where the consideration of a demerger of a company may go to the shareholders directly, not to the company. Not to the transfer company as such. So therefore, those kind of things may arise there also.
Right.
So exactly, I appreciate those things can. There is something which it can lead to some hardships, maybe. But yes, those cases will be dealt with once we look at it thoroughly. Right. Sriram, what do you think? I mean, we can envisage such a situation.
Yes, sir. The only defense I have, I didn't look at it from that perspective, like our research pointed out, is 46A is technically a charging section. Therefore, to apply the charge, they brought in this interpretation, whereas 50CA, etc., are machinery provisions. Can we extend the same rule of interpretation for machinery provisions also is something which we can examine.
True. But that's a good thought. We can leave it for a day when we actually face it.
True.
Yeah. So, Amol, back to Amol.
Sir, since we are on it and, the discussion is taking place, maybe we can have the audience, the house open for questions on this topic, because since we are on it, if Prakash, if anybody is, has put in the chat box any queries, maybe you can read them out and the panel can, give an answer on those thoughts.
Sir, may I request that let the Q&A session should be at the last here. Otherwise, we will get deviated from.
Right. No, agreed. So I'd request Sri Gaurav Jain to once again take the baton, and lead us through the next judgment.
Sure. Thanks, Amol. So, friends, the next decision which we are discussing is Sheetal Fibers versus CIT 476 ITR 309. This decision basically interprets Section 80IA9, which was an issue which was pending for long. And as we will walk through these slides, we will see that there had been conflicting decisions from the High Court. There were two special benches from the tribunal, three judges special bench, and then a larger 5 judges bench was also constituted, which is generally very rare amongst the tribunal to be constituted. And last but not the least, even at the Supreme Court, there was a dissent amongst the 2 judges when this issue was referred to a larger bench, and now this decision from the larger bench, the third member has decided this issue. So the issue broadly is, friends, that whether because of section ATIA 9, if the profit of a eligible undertaking has been subject to deduction under section 80IA, whether that amount of deduction will be reduced from profits available for deduction under any other provision of chapter 6A like section 80 HHC, or the intent of section 80IA 9 is to restrict the cumulative deduction of both the provisions to be computed independently, but the overall deduction needs to be restricted to the profit of that particular undertaking. The issue has arisen because of the language of section 80IA 9, which is throwing multiple interpretations. So for the benefit of all, I'll just read that 80IA 9 provision, which is there on the slide, where any amount of profits and gains of an undertaking or of an enterprise in the case of an assessee is claimed and allowed under this section, that is 80IA, for any assessment year, deduction to the extent of such profits and gains shall not be allowed under any other provisions of this chapter under the heading C, deductions in respect of certain incomes, and shall in no case exceed the profits and gains of such eligible business of undertaking or enterprise as the case may be. So this section had basically twin parts, that where eligible profit has been claimed and allowed deduction under section 80IA, then such deduction shall not be available under any other provision of under the heading C of chapter 6A. And now this is separated by the word and, that deduction shall in no case exceed the profits and gains of such eligible business of undertaking or enterprise as the case may be. So the issue arises whether it has to be deducted at the threshold or the overall deduction needs to be restricted to the total income, and I have explained it with the help of an illustration on the next slide. So just for the sake of completeness, let us say the total income of the undertaking is rupees 1000, and deduction under section 80IA, assuming to be 30%, works out to be rupees 300. So there is no dispute on the computation of 80IA, both as per the assessee as well as per the department. Now suppose that eligible undertaking is engaged in the business of exports and is also eligible for deduction under section 80 HHC. Then as per the assessee, the 80 HHC deduction will need to be computed independently on profit of rupees 1000, and let's say the rate of deduction is 50%, the 80 HHC deduction will come out to rupees 500. This is as per the assessee, and both cumulative deductions 800 we can reduce from 1000 to arrive at net income of 200. Whereas the department says that no, as per 80IA 9, you have to reduce rupees 300 of deduction under section 80IA from overall profits of 1000 to consider eligible profit under 80 HHC at rupees 700, which will reduce the 80 HHC deduction to rupees 350, and therefore the overall deduction will be restricted to 350 plus 300, that is 650, and the net income of 350 will be subject to tax. So in this illustration, we can see that as calculation as per the assessee, the taxable profit after deduction is 200, whereas as per the interpretation of 80IA 9 as per the revenue, the eligible profit is high, that is rupees 350. So this is the whole controversy, which was, if we move to next slide, there were conflicting decisions. The first was a special bench decision formulated at Chennai. It's a 3 judges special bench in Rogini Garments. Then even a larger bench was constituted because there was a conflicting High Court decision in between, and to reconcile the interpretation of High Court, a larger bench was constituted in Hindustan Mint and Agro, which was again against to assessee, where the restrictive interpretation of 80IA 9 was held. Delhi High Court in Great Eastern Exports was against. Punjab and Haryana High Court in Friends Casting Private Limited was against, and there would be some more High Court judgments. Next slide. In all these decisions, the tribunals and High Court applied the literal interpretation of section 80IA 9, and they held that on literally reading it, the first part of 80IA 9, which I read, that once the profit has been subjected to deduction under Section 80IA, then that profit will go to reduce the eligible profit for deduction under other chapters. So this they interpreted it literally to come to that conclusion. But there was a favorable decision from Bombay High Court in the case of associated capsules, which has been largely approved by Supreme Court in the present decision. And they said that no, literal interpretation is giving absurd result. What the scope of Section 80IA 9, we have to apply at the stage of allowing deduction and not at the stage of computing deduction. So for instance, if I have to compute deduction under Section 80HHC, 80HHC is a provision independent and standalone in itself. 80HHC do not permit reduction of its profit by any other deduction. So therefore, I will compute deduction 80HHC independently. I will compute deduction under Section 80IA independently. So at the stage of computing, we do not need to rope in 80INN. But when I am reducing those deductions from the GTI while computing my total income, at that stage, I will need to restrict the deduction under 80HHC to the remaining profits remaining after reducing the deduction under Section 80IA. So this is what Bombay High Court held. On the next slide, the Supreme Court in the present decision has largely and broadly upheld the decision of Bombay High Court, and they have negated the decisions of other High Court to approve the ratio laid down by the Bombay High Court. That is, 80IA 9 impacts the stage of deduction and not the stage of computation of deduction under any provision of Chapter 6A. The Honorable Supreme Court relied upon the intent behind insertion of the aforesaid provision. So here they are applying the purposive interpretation by making reference to circular issued at the time of amendment to provide that the object of Section 80IA 9 was to prevent taxpayer from claiming repeated deduction in respect of same amount of eligible income so that total deduction does not exceed eligible profit. Lastly, the Honorable Supreme Court held that if the argument, previous slide only, if the argument of the revenue of reducing profits while computing deduction under Section 80HHC is accepted, then the same would lead to absurd and unintended consequences and would render the formula for computing deduction under Section 80HHC to be ineffective and unworkable. Accordingly, the Honorable Supreme Court applied the principle of contextual interpretation. So friends, although it's a old litigation, because now both the sections, especially 80HHC, etc., have lost their life, but still for the pending issues, this decision assumes importance. And last but not the least, as we can see even in this decision, the Supreme Court is applying the principles of interpretation. Here the Supreme Court has given importance to purposive interpretation, contextual interpretation, by relying upon the circular, by first coming to the conclusion that the literal interpretation was giving an absurd result. And they have given an illustration to that effect that 80HHC formula will become unworkable. So after holding that literal interpretation is failing in this kind of situation, they went to the context and purpose, legislative intent behind the provision, to come to the conclusion that overall deduction needs to be restricted to the eligible profit, but we do not need to disturb the computation of each provision by virtue of Section 80IA 9. So this is what Sheetal Fibers is. Over to Amol.
Pannu sir, and my thoughts on this judgment are that the Supreme Court has eschewed the literal interpretation, where it was leading to an absurdity, and has gone to the purposive interpretation. And sir, so therefore, in my opinion, this goes a long way, and it has other ramifications as well insofar as interpretation of the various other sections are concerned. What are your thoughts on that, sir?
No, undoubtedly, if we look at the manner in which the judgment has been, constructed, I would say, so they have gone by the scheme of the Act. They looked at the entire scheme, starting from the computational, starting from the chargeability sections up to the manner of computation up to Chapter 6. And thereafter, within 6A also, they have looked at the definitions of what does 80A mean, what does 80AB stand for, what is the definition of GTI in 80B5, and then coming to the restriction of 80IA 9. And to make it workable and operational, as Gaurav pointed out, and to make it more relevant, and harmonious. They have, in fact, they have supported their decision by pointing out the difference between different subsections of Chapter 6A. For instance, they say that the expression in ATIA 9, it does not, it only says shall in no case exceed the profits and gains, and it does not say, to the extent of such deduction to the extent of such profits and gains shall not be allowed under any other provision of the Act of this chapter under the heading so and so, and shall in no case exceed the profits and gains of such eligible business. So they say that it only says shall not be allowed, and does not say that shall not be qualifying for any other provision. So therefore, they have made a distinction as to when does ATI 9A comes into operation. Does it come into operation when we compute the individual deductions under the Chapter 6A Part C, or at the time of its allowance against the GTI, so as to be arriving at the total income of the NSSE? I think that is what has been brought out, and the example which Gaurav shared with all of you brings out the entire thing. Plus, they have also referred to say that the expression shall not qualify exists sections like ATHH B5, ATHH D7, which relate to export profits and all in certain in a specific context of activities. There, the words used are shall not qualify, whereas in this there's a shall not be allowed. So therefore, they have said that there's a difference between the two, and that is why, in fact, Gaurav pointed out the history whereby the matter had to go to a larger bench, and it was in 2015 that the judgment of the decision of Punjab High Court, I think that was Punjab High Court decision of Micro Labs Limited, which was before the Supreme Court bench into a difference.
Yes.
And the current bench has also very heavily relied on how the then Chief Justice, of course, he was then Justice Deepak Mishra ji, that he has seen the entire thing, the controversy, and I think it settles a lot of past legacy of disputes, and of course is also a pointer to other such sections which have an overlapping. The chapters may have an overlapping situations where more than one deduction is available for an SSE, and how will it operate? That's how it is. I think if we have questions, we can take it up later, I think.
Yes, sir.
So back to Anmol, you can proceed further.
Yes, sir. Sriramji, I request you to.
Yes, sir. The next judgment, I frankly don't know to what extent it's going to draw all non-residents to. The amount involved in this matter was 5 lakhs per year or 8 lakhs per year, small amounts. This judgment is like the judgment of Supreme Court in TV Sundaram Iyengar, where the tax effect on write-off from the deposit written off was for some 28,000 rupees. But Supreme Court said even then amount is small, we want to pass a judgment in this because issue is interesting. To one such case where it might have far-reaching implication. Section 71 and 72 provide for set-off of business losses or carry forward and set-off of business losses. Section 37 allows a deduction for expenditure incurred wholly and exclusively for the purpose of business or profession. Both these sections do not say expressly, or no other section in income tax also will not say that the business has to be carried on in India. It is impliedly to be read that for these sections to apply, that the business has to be carried on in India. It's not a point of whether expenditure is incurred in India or not. The Income Tax Act itself is attracted only if business is carried on in India. If no business is carried on in India by a non-resident, more particularly, none of these sections will get attracted. Section 32, which provides for depreciation, subsection 2 of the section which provides for carry forward of unabsorbed depreciation, had a proviso which said that unabsorbed depreciation will be allowed to be carried forward if the business for which the depreciation allowance was originally computed continues in the previous year in which the assessment year in which it's questioned. That is, accumulated unabsorbed depreciation was permitted to be carried forward under 32(2) only if the business is carried on continuously. This condition was also omitted by the Finance Act 2020. This is the broad background. Now, coming to the facts of this case, the assessee is a French company which is engaged in offshore drilling activities. It had a 10-year contract with ONGC between 1983 and 1993. The contracts are awarded by ONGC in a bid. Initial 10 years contract was awarded. Thereafter, when it bid after the conclusion of the contract in 94, 95, 96, etc., it did not succeed in the bid till 1998. But between the period 1993 and 1998, the assessee received income tax refund for the past years that it had paid. Along with the income tax refund, it received interest on income tax refund also, which was liable to tax in India. The assessee was incurring some small expenses in relation to the Indian so-called operations, administrative expenses, audit work, filing of return every year, etc., which was 1 or 2 lakhs every year. It also had accumulated unabsorbed depreciation for the past period. It sought to claim set off of these losses, that is, set off of these business expenses incurred under Section 37(1), as well as the unabsorbed depreciation loss against the income tax refund interest that it earned. Assessing officer denied the set off of losses on the ground that the assessee between 1993 and 1998 did not have any business presence in India at all. Without a business presence, it cannot claim an expenditure under Section 37(1). When there is no expenditure under 37(1), which is allowable under the Income Tax Act, it cannot claim a set off of losses under either 71 or 72. This is what assessing officer held. CIT appeals also upheld, tribunal overruled it. High Court overruled the tribunal's judgments and held when the assessee does not have any presence absolutely in the country, merely participating in tender will not amount to carrying on business in India, and therefore the expenditure that it incurred between 93 and 94 for filing income tax nil returns, etc., or audit fees, etc., cannot be allowed to be set off against the interest income that he earned from the income tax department. The Supreme Court, Division Bench of the Supreme Court, referring to various judgments on what is meant by business, what is a temporary lull in a business does not amount to cessation of business, etc., finally concluded that business means a wide scope and includes acts which are incidental to the carrying on of business. That is, when between 93 and 98, the assessee sitting in France was participating in the bids floated by ONGC and was communicating with ONGC sitting in France, that will also amount to carrying on of business by the French company. That poses no problem. The Supreme Court went on one step ahead to say that the French company, by doing those activities, will effectively be regarded as carrying on business in India. Therefore, the Supreme Court held that assessee will be eligible for deduction of 37(1) and can set it off against the interest income, etc. What is alarming for me is one paragraph in this judgment, para 20, which reads like this: in an era of globalization, whose lifeblood is transnational trade and commerce, the High Court's restrictive interpretation that non-resident company making business communication with an Indian entity for its business foreign office cannot be construed as carrying on business in India is wholly incorrect. This is what the Supreme Court says. The Supreme Court says that the High Court was incorrect in saying that sitting in France, communicating with the prospective customers does not amount to carrying on business in India, is what High Court held, that the Supreme Court says is incorrect. effectively meaning sitting in France, if someone communicates with the prospective customers in India, that amounts to carrying on a business in India. The amount involved in this matter was small, but according to me, it might have huge repercussion in case of 911. Tomorrow, if the revenue wants to rely upon this judgment to say, even without a physical presence in India, more particularly in terms of electronic transactions, and the observation that in cross-border transaction these days, such transactions can amount to carrying on business in India, leaving aside PE exposure for a second. The revenue authorities are given a free hand now to go to a large extent, and we'll have gala time. This is what I wanted to highlight and leave it across to the panel for their comments and discussions.
Sriramji, thank you. I think, what you have highlighted has a very large ramification given, the manner in which how business is now conducted. So it will lead to, in my opinion, a lot of litigation on this issue. Because not only, like in this case, the SSC was based out of France, but participating in ONGC tenders in India. But there can be various other instances where, now through the e-commerce mode and through various digital transactions which are taking place, and the pace is increasing and the quantum is also increasing. It will have a very large ramification on the SSCs. Pannu sir, your thoughts on this?
Right. So you see, I can understand the fear of Mr. Sriram. It's coming from the kind of open-endedness it's said in the section. But then the fact is that ultimately, if we were to apply this in the context of 911, there are many other things which also need to be governed. One, two, in any case, their observation is in the context of the facts which they have discussed in the earlier part of the whole scheme and the question that was before them. So, though it would be, playing a devil's advocate, perhaps what you are perceiving is a fear, but I think it can be tackled once we are faced with that situation, because nowhere have they gone along with 911. Of course, they have in a sweeping statement said a combined reading of the charging provisions under section 452 read with 911 make it amply clear that non-resident shall be liable to pay tax on income which is deemed to accrue or arise in India. So this having said that, they 911 income accruing arising directly or indirectly through or from any business connection in India is deemed to accrue in India and is accordingly chargeable tax. All these things have said, but in what context? None of these provisions make it mandatory for a non-resident to have a PE in India to carry on business or have any business connection in India. They have thereafter safeguarded by saying that the PE is relevant only when we talk of the DTAA, but not for the purposes of this case. So perhaps we can argue it out. It can very well argue that those observations are in the context of what was before them. But yes, if you look at other decisions of the Supreme Court, like the other day we were looking at that Hayat case. So there also, it was not necessarily what was just the agreement, not only also one continued physical presence, the physical presence enabled by the kind of arrangement which they brought in. So qualitative tests were also brought in, not merely the physical test. So to that extent, yes, and this also is an observation which is a pointer for the subsequent jurisprudence which we have to encounter. But certainly these observations by itself cannot be enough to get you into trouble. But yes, there can be some litigation which may prospectively be built over such a concept being propagated by the Supreme Court, though not necessary and required for the purposes of disposal of their appeal. That's how.
Sir, can I come in?
Yes, Gaurav.
Sir, very rightly put it. I think the issues raised by Mr. Sriram are there. But to my mind, given the facts before the Supreme Court, what they were examining is whether the foreign company was carrying on business in India or not. by way of although it or whether there was a temporary lull in business or not. Carrying on of business would, to my mind, be different from business connection in India, for which we will need to see the definition of business connection contained in the act as interpreted by the courts like that of R.D. Agarwal, etc. So they have only restricted themselves to interpreting whether the company was carrying on business or not for the purpose of allowing expenditure.
That's right. So, but what Sriram's point is that perhaps the logic taken could have been better. I mean, that's the way. The conclusion, I don't think anybody disputes the conclusion, because they were probably looking at what the High Court probably did not find any distinction between the concept of lull in business and cessation of business. So they're trying to correct that wrong. Probably the logic which they took by way of the language is something which gives rise to that doubt. But anyway, you have rightly pointed out, there are more contours to it when it comes to 911 and all. So I think we can proceed further.
Sir, I had an observation on this that
yes.
going through the judgment, in my opinion, this is the observations which Sriramji pointed out was more in the nature of an obiter rather than the ratio.
That's right. That's one of the arguments which anybody will be taking.
Yes.
Were they necessary to dispose of
the appeal?
But then Sriram will answer you by saying an arbiter by Supreme Court also is binding. So therefore, I didn't want to get into that discussion. But yes, we will certainly. The other side will have to build up the case. So Sriram definitely will write in saying, look, arbiter by Supreme Court is in the nature of dictum. So therefore, this is a grey area. But yes, I don't think it is something it is definitely surmountable, not something unsurmountable. But yes, they could have done it better, I'm sure.
Precisely. So, Gauravji,
request you to. Sure. So, friends, the next decision is the very latest decision in the case of Sharp Business System, which dealt with the allowability of non-compete fee as a revenue expenditure or as a capital expenditure. So basically, broadly, the issue is that in the facts of the present case, the assessee had a collaboration with a partner, and while that they were parting ways, the assessee paid non-compete fee to the parting collaborator to not to compete with him for a period of 7 years in that particular business. And the non-compete fee paid was claimed as revenue expenditure, business deduction under section 37(1) of the Act, which was disallowed by the department, holding it to be capital expenditure. So the issue before the Supreme Court was twofold. One, whether this is allowable as revenue expenditure or as capital expenditure. And if it is to be held as capital expenditure, whether the non-compete fee can be subjected to depreciation as intangible asset under section 32(1)(2) of the Act. The Delhi High Court, the underlying Delhi High Court was against. There were certain other favorable decisions, but this particular judgment has come in against the Delhi High Court judgment, which was challenged by the assessee. The next slide, please. So basically, the argument of the revenue was that the assessee had got a benefit, enduring benefit, by way of avoiding the competitor from doing competition over a long period of time of 7 years. So there is an enduring benefit, and that too in the capital field, by eliminating competition from the core business for a period of 7 years, and therefore this expenditure is a capital expenditure. On the contrary, the argument of the assessee was that this is not an enduring benefit in the capital field, since the business, the benefit is not on the capital account, that is not on the profit earning apparatus or on the business of the assessee, but by eliminating the competition, the assessee would be earning better profit. So the apparatus remain intact. The benefit is accruing only on better profitability, and the length of time, that is whether it is 7 years, more years or less years, is not determinative to qualify an expenditure to be capital or revenue in nature. So until and unless benefit of enduring nature enhances the profit earning apparatus, or to call enduring benefit in the capital field, the expenditure cannot be considered as capital expenditure, but would be regarded as revenue expenditure. Alternatively, it was argued that this non-compete fee should qualify under the residuary category of an intangible asset under 32(1)(2), because when department is itself holding it to be a capital expenditure, then I must be considered as having acquired intangible asset of commercial nature to be allowed depreciation thereon under section 32(1)(2). Next slide. Next slide. The Supreme Court has broadly upheld the contention of the assessee and reversed the decision of High Court to hold that non-compete fee is allowable revenue expenditure, because they held that the benefit was not in capital field. The non-compete fee merely seeks to protect and enhance the profitability of the existing business and thereby facilitates the carrying on of existing business more efficiently and profitably without acquiring any new asset or accretion to the profit apparatus. Therefore, they held that enduring advantage is not in the nature of capital expenditure, para 26. Para 27, again important finding, the length of time, that is over a period of 7 years, the advantage may inure to the assessee is not determinative of the nature expenditure. The crucial test is whether the benefit is in the capital field or not. The third observation is very important. They said that ultimately by making this payment, the assessee has not eliminated the competition completely to monopolize that business. It has only restrained one competitor, that is the existing collaborator, from competition, and therefore there is no advantage inuring on the capital field. So accordingly, for the aforesaid reasons, the Supreme Court upheld the contention of the assessee to hold it to be a revenue expenditure and not a capital expenditure. And since they held it to be a revenue expenditure, they did not went into the issue of eligibility of depreciation thereon and left it open. So with that, they have decided the issue. I think it was a very old issue. At least we see in Delhi jurisdiction, in tribunals, etc. The Delhi High Court was consistently being followed to disallow non-compete fee, which pursuant to this decision, I think will stand reversed. And again, important tests reiterated the old decision of Supreme Court in Empire Jute Company, which had held that enduring benefit must be in the capital field, has been re-emphasized, reiterated. The benefit over a long period of time is not determinative, is again reiterated to come to the conclusions of what is capital and revenue. And therefore, it is an important decision for two reasons. One, laying down the tests of allowability of a capital or revenue, and to freeze the issue of allowability of non-compete fee as a revenue expenditure. So this is what the decision is. Over to Amol. So one more finding. Sorry, one more finding.
Sure, Gaurav, go ahead.
Yeah. Sorry, I missed the last slide.
Go ahead. Yes.
Yeah. So one more important finding from the decision is whether the interest expenditure incurred on borrowed funds, which are further utilized for investment in shares of subsidiary or group companies to acquire controlling interest or to give interest-free advances to sister concerned directors, whether it is allowable deduction or not. Insofar as the second issue, that is interest-free advance to sister concerned director, I think we had the decision of Supreme Court in SA Builders, where the Supreme Court had held that where the advances, interest-free advances are given out of commercial expediency to sister concerns, then it is allowable deduction too. So to that extent, the decision was already there. It has been reiterated. It has been re-emphasized, upheld. I think the second issue, that is investment in shares to acquire controlling interest, we had several decisions, but not from the Supreme Court. So to that extent, there is a finality from this decision that if you make investment in shares of group companies to acquire controlling interest, I think that interest expenditure will also be allowable as deduction, but subject to a caveat. I think on the facts, what they have emphasized is that the investment in shares of subsidiaries were engaged in similar line of business. So it's not just acquisition of controlling interest, but I think the fallout of the decision would be that the subsidiary company must be engaged in similar line of business so that I can claim deduction of interest expenditure. Maybe if the subsidiary company is not engaged in similar business, this decision may not directly come into the play. We may have to otherwise establish what was the commercial expediency behind investment in shares. But in this decision, they have emphasized on two things: one, similar line of business, and to acquire controlling interest. So to that extent, this decision has given finality on allowability of interest expenditure on these kind of transactions under section 36(1)(3). Yeah, Amul, now you can come in.
Thank you. Pannu sir, your thoughts on this judgment? And
Sriram want to say something? We can ask him. If Sriram,
yes, Sriramji, your thoughts on the judgment? Sriramji, kindly unmute yourself.
Sorry, my apologies. This is a very long pending disputes before various forums on non-compete fees. This is a very useful judgment. But again, the deduction for non-compete fee will, according to me, depend upon the terms of the non-compete agreement. This can be used as a thumb rule, but will not mean every non-compete fee will be allowed as a deduction.
That is true.
Yeah, he's right. If I can come in, maybe the cases where the assessee is getting a monopoly right, the revenue can argue that this decision is not applicable because the Supreme Court has emphasized that in facts of the present case, the assessee did not got a monopoly right by entering into the non-compete agreement.
That is Gaurav debatable, because when they also spoken about the fact that yes, the stated objective is to eliminate competition for the benefit and protection of its own business. But did the benefit actually result? Could he sell it in the market? Did he actually protect his business? Is the question, which is uncertainty.
Sure.
So therefore they said that you cannot be certain with this. So that is one of the factors which they went in and thought that no, it's a revenue expenditure.
Sure.
But more than that, if they have, of course, they started with the caveat of saying that there is impossible to formulate a general rule. And as Sriram rightly said, that it will depend on the facts and how the whole agreement is. And they quoted a very celebrated case of Atherton. I would just say I'll just read the 3 lines, which will give the desired impact. It's the judgment says, quote, when an expenditure is made not only once and for all, but with a view to bringing into existence an asset or an advantage for the enduring benefit of a trade, I think that's a very good reason for treating such expenditure as properly attributable not to revenue but to capital. But when they say very good reason, there is a exception to that which they said as a bracket. I think that there is a very good reason, bracket, in the absence of special circumstances leading to an opposite conclusion. And this is what exception was was in fact emphasized by Supreme Court in Empire Jude's case, where they said where it is an advantage of enduring benefit for the trade, but if it is in the revenue field, meaning that no new asset is brought in, but it is to increase the profitability and carrying on the business more efficiently, yet it will be taken as revenue expenditure. And that perhaps is how even this judgment has been, that's the fulcrum of the entire thing. Other, one thing which is perhaps bothering me in the entire judgment is the directions given by them in paras 32 and 34. You see, this judgment was not only, of course, Gaurav sitting in Delhi jurisdiction, I can understand his plight, because it was very difficult for him to overcome sharp business of Delhi High Court all along. Although the other high court jurisdictions, they were more taxpayer friendly. But you see, the judgments which were up in appeal before the Supreme Court, one was in the issue of the non-compete fee being taken as revenue or a capital expenditure. Other decisions coming from Madras High Court and also perhaps I think Bombay, they were on the issue where the assessee had himself took it as a intangible asset, capital right, in the right, a commercial right, capital in nature, and therefore should be eligible for depreciation for an intangible asset. So that was the questions primarily, not necessarily revenue versus capital, because that was not the case of the assessee either before the AO or before any of the lower authorities. But what the Supreme Court has said in para 34 is, it says, as regards the remaining appeals, we are of the view that it would be appropriate if all the matters are remanded back to the respective tribunals. All appeals, cross appeals are revived and heard afresh, having regard to the ratio laid down in this judgment. And the ratio is whether it's to be a revenue or capital. That was the question they have answered. That is, they set out the question themselves in the initial paragraphs. And they have also followed up in 34 saying, since the cross appeals before IT-80s have been revived, parties would be at liberty to raise additional grounds based on the present judgment. The present judgment is only based on the revenue and capital controversy. Any assessee, perhaps in his wisdom or looking at his own affairs of tax, may not have preferred to claim it as a revenue expenditure. They would have preferred to claim it as a capital expenditure or as intangible asset, where they were wanting a depreciation under the Income Tax Act. They may or may not. It may not be beneficial to them to take it as a revenue expenditure. And Taparia tools is already there to say that you cannot force a person. Look, you only take it as a revenue expenditure or a capital loan. So what I feel is that yes, perhaps it was not appropriate for all the decisions to have been taken up together by the Supreme Court. They could have confined themselves to the question of law which was appearing, which they have formulated also, and the other judgment which did not have that kind of a claim by either side. Nobody, in fact, neither revenues case nor cessis case, other decisions in appeal before Supreme Court, that this is the revenue expenditure. I think that's the fallout we must consider. But of course, that is prospective in nature. And let's see what happens at the level of tribunals when the matters are taken up. There is a direction now.
So, sir, isn't it beneficial for the assessees in as much as although they might have claimed capital expenditure and depreciation, there will be announcement.
I'll give you an example. Depreciation, you may not necessarily be wanting to absorb in 8 years. But a business loss, if taken as such, may not be beneficial to you. You may not be in a position to absorb in 8 years. The person would have, by its own nature, would have thought over it and said, look. And secondly, with the Supreme Court is also, recognized that whether it is revenue or capital, you have to look at from the perspective of the businessman. In the paragraph, I would say, para 28, if you look at it, the non-compete compensation from the standpoint of the payer of such compensation is so paid is. So underlying thing is that how does the payer view it? If you pay something at the beginning of which they did in this case also, which you can possibly add to your cost of setting up the apparatus, the business apparatus, it is your standpoint. And the revenue, so there is nobody's case from the side of the revenue in those cases to say that no, this is revenue expenditure. So therefore, this, to my mind, is something which could have been best avoided. I mean, it's just an observation as a practical, on the practical standpoint of it. But let's see how it goes forward. Sriram, what do you think? This will unnecessarily lead complication to people who have not claimed that it as revenue expenditure.
Yes, sir. More particularly the example that you pointed out, someone who has long gestation period for profits. Depreciation is allowed without any time period.
Correct. So let's see. But yes, that's it. So Anmol, you can take it forward.
Yes. So Sriramji sir will now present the final case in detail before we run through the couple of other judgments. So Sriramji, please do the honors.
Thank you, sir. Sir, is a matter relating to levy of penalty. For a very long time, we had a single provision for levy of penalty in relation to escapement of income. It was 271(1)(c) that covered various situations and aspects, etc. Explanation 5 to 271(1)(c) dealt with the case of levy of penalty in case where undisclosed income is found during the course of search. Lots of dispute arose on interpretation of explanation 5 at what is meant by undisclosed income, which is the year the income relates to for the purpose of levy of penalty. To overcome that, in 2007, a new section was introduced and codified in 271 AAA, which provided that where any undisclosed income is found in the course of search, which the assessee discloses to the investigating authority, pays up the taxes and interest, substantiate the manner in which the undisclosed income was earned, then penalty will not be levied under the section. It provides for clause 1 provides for a levy of 10% penalty. Clause 2 provides the penalty will not be levied if the assessee discloses the manner in which the undisclosed income was earned, pays up the taxes. It was some inducement to the assessee to pay up the taxes, not to dispute the admission. The section was subsequently made ineffective, but has continues in the form of 271 AAB. In this case, a search was conducted on the assessee, who was a land aggregator. He had, during the course of search, disclosed an additional income of around 2.2 crores to the search party, 2.27 crores to the search party in relation to one set of customers. After the search was concluded in his premises, and after the assessing officer issued a notice under 142(1), he filed an income tax return, wherein he disclosed another set of income of 2.5 crores in relation to another customer. Apparently, from the reading of the tribunal's judgment, it appears that Income Tax Department was not able to get the details relating the second set of customers during the search in his premises, but found the documents relating to the assessee in a search conducted in the Class B customers that he had. So, because he was afraid that the Income Tax Department will get to know about the other income which he had not earlier disclosed, in the return he filed, in addition to the 2.2 crores initially offered, he offered another 2.5 crores as income. Assessment was made on the aggregate income because dispute was only in relation to penalty. CIT appeals, the ITAT, and the High Court, all three authorities unanimously upheld the penalty, and the penalty was levied on the entire amount of 4.7 crores. The interesting issue here was the assessee did not pay up the tax for a very long time, but it paid up the taxes, it paid it along with the interest. The assessee argued before the Supreme Court. All the three lower authorities have treated the penalty as being automatically applicable in the case of an assessee once a search happens and the conditions of subsection 2 are not satisfied. On this point, the Supreme Court held penalty is always discretionary of the assessing officer, more particularly when the section uses the word that the assessing officer may levy a penalty. 271 AAA penalty is to be imposed at the discretion of the assessing officer and not automatic. The Supreme Court went on to say it is the duty of the assessing officer to prove that the income which is seeking to assess or seeking to be subject to penalty is an undisclosed income. But the Supreme Court went on to grant some relief to the assessee to say, in relation to the amount which he had disclosed before the search party at the time of search of 2.27 crores in relation to Class A customers he had, the immunity provided in subsection 2 will apply. The revenue argued that the tax was not paid up by the assessee for a very long time, which is required under subsection 3 or clause 3 of the subsection, to which the Supreme Court held the section does not provide for a date by which the assessee has to pay up the taxes. So long as the assessee pays up the taxes or penalty along with interest, the immunity provided in subsection 2 will apply, and therefore deleted the penalty in relation to first class of assessees. When it came to second class of assessees, assessee very smartly argued that what can be subject to penalty under 271 AAA is undisclosed income found during the course of my search, during the course of search in my premises, where the Income Tax Department has found materials incriminating the assessee in the course of search in other premises, the section would not apply. Supreme Court did not agree to this premises, did not agree to this argument, and held found in the course of search as used in this section has wide amplitude and includes documents obtained due to a search even from a third party. It says found in the course of search does not necessarily mean found in the course of search in the case of an assessee, found in the course of search of other parties also. This is all the Supreme Court says. I don't have anything else to add. The other panelists to comment upon this.
Gauravji, would you like to add to what Sriramji?
Yes, certainly. I think while the decision is on facts, but to my mind, two important observations have emanated from this decision which can have far-reaching implications. With respect to the first disclosure on which the immunity was granted and penalty was deleted, there is an observation at para 34 while dealing with the word undisclosed income, where they say that merely because the assessee has made a surrender and the AO has not discharged the burden of founding the undisclosed income, which is represented by asset, undisclosed income, books of account, etc., that by itself will not be an undisclosed income. So we have had decisions from the high courts so far when it comes to making assessment on the basis of statements rendered at the time of search, which are not backed by incriminating material. So the high courts have there has been a dissenting view from different high court, but Delhi High Court has held that no, simply on the basis of statement without any material found in the course of search, you cannot satisfy that cannot be the basis of addition. So even if we read this observation at para 34 as obiter, I think this obiter observations can put a quietus to that issue, which will have important bearing and can be used as a precedent on this very issue. The second important issue, which is whether it is found in the course of search or it is found in the course of consequential search at the third party premises. I think when we come to discussing the issue scope of assessment of 153A or 153C, or even in new 148 provisions, whether the material is found in my premises or third premises, whether it needs to be assessed under 153A or 153CA, according to me, this decision can have some implications and can come as a precedent that even if a document is found not from your premises, but as part of a consolidated search or a consequential search at third party premises. Let us say the search had happened on a company and a director, and a document in relation to company is found from the premises of director. Whether on the basis of that document, applying Supreme Court decision in Abhisar Bildwell, whether the scope of assessment is under 153A or under 153C. So this decision may put a quietus to that issue that no, if it is a consequential search, then the document must be considered as being found in the course of your search only, and therefore an assessment can be made on the basis of that material, applying Abhisar Bildwell as also under 153A. So I think although it's a decision on 271 AAA on its own facts, but few important observations and ratio is emanating from these decisions. This is my reading of the judgment.
Thank you, Panu sir. Your quick thoughts on it before we...
Yeah, Amol, see, of course, one thing, I think it's a mixed bag in the sense that it's a double-edged sword, how the Supreme Court has done it. Though it says that for the purposes of demonstrating undisclosed income, the onus is obligatory on the part of the assessing officer to demonstrate and prove that undisclosed income satisfies what is expected in the explanation. But then, in the course, what is expected of the assessing officer, they have enlarged the scope. In the sense, the expression used in the explanation is found in the course of search, which they have also equated to another expression which is not there in the Act, which is anything found as a result of search also. So the expression as a result of the search is quite different from what is found in the course of search. So they have enlarged the scope of what is expected in the section. So thereby diluting the onus which is otherwise they cast on the assessing officer. That's why I'm saying it's a double kind of a thing. It's a mixed bag. So you put the onus on the assessing officer, but he need not confine himself to found in the course of search, but also, or they use the word or, found during the course of search or as a result of the search, thereby diluting the onerous task which otherwise the assessing officer had. So therefore, maybe on the facts, they could have found it against the assessee, but laying down this interpretation here and putting it those words, which are obviously not there in the Act, and as a result of search and found in the course of search are two different connotations. But perhaps this was never argued before. The legal point should have been argued. I mean, I don't think there was any formulation of these two concepts which were to be brought out and argued. So that's why I think Gaurav is right in saying that this may have its own connotations, but then we must be careful what concepts are being debated, whether. So I think, Sriram, this is what I feel is going to be the main challenge.
Precisely, sir.
Let us
see.
see.
Now, I mean, before we take the discussion further, because of paucity of time, I'd request both Gaurav ji and Sriram ji to quickly give us the there are some other judgments which are to be highlighted and pointed out.
Yes.
So I'd request them to quickly just give us the upshot on those judgments. Thank you. Over to Gaurav.
Yeah, please keep in mind that we have to take the question answer also, please.
Yes. So Prakashji, that's the whole idea that Gauravji and Shriramji, I'm sure, will summarize it.
Yeah, please be very crisp here on giving the short presentation of the remaining judgments, sir.
Okay. So I'll start. I think Shriram, it's my turn, no? Maruti Suzuki.
Yes, sir, you can complete all three.
Okay. So Maruti is a judgment on duty drawback. I think they in this decision, the Maruti has only reiterated the settled position laid down by Supreme Court in Excel Industries that duty drawback does not accrue as income at the time of export, but only when the claim is accepted by the government authorities, that there's a right to receive accruing in the hands of the assessee, that duty drawback can be brought to tax, and this was settled by Supreme Court in Excel Industries. They have only reiterated. I think the issue before the Supreme Court was also not on the nature of income, but what had happened is that Bombay High Court, the tribunal had remanded the matter back to the AO to verify whether the claim has been accepted by the department in the year under consideration or not. So there was a limited set aside. The High Court had overturned this set aside, saying that when the issue is covered by Excel Industries, there was no need for set aside. The Supreme Court has reversed the decision of High Court and said that the remand was only for a limited purpose of verification. There was no reversal of the law by the High Court and by the tribunal. They have upheld the decision of the stage of accrual. So therefore, the limited set aside was right in law, and which has been now approved by the Supreme Court. So this is a very limited and a factual matter, to my mind, not laying down any large proposition.
Thank you, Gaurav. Can we quickly have the other two judgments which you have?
So next is VCon integrated, that is on scope of section 263. This is a very short but a very important judgment. In this judgment, the Supreme Court has said that under 263, the error on the part of the assessing officer can be twofold. One, not in conducting the relevant inquiry, and two, after conducting the inquiry, not coming to the proper conclusion or decision. The Supreme Court held that under 263, the CIT can, in both the situations, revise the assessment order, but the scope of CIT under 263 is different and limited. So, for instance, if after conducting an inquiry, the AO comes to a wrong conclusion, then the CIT cannot set aside the matter back to the AO. He has to himself decide the issue on merits and make an addition or disallowance. And suppose the assessing officer, the CIT is of the view that AO should have conducted more inquiry. It's a case of inadequate inquiry. Then also he cannot make a blanket set aside to the assessing officer. CIT will need to come to a finding, definite finding as to what was an inadequate inquiry, how the inquiry was inadequate, what more ought to have been done. So although explanation 1 to section 263, which empowers the CIT to hold the assessment order to be erroneous if there is an inadequate inquiry, but as per the decision of Supreme Court, that by itself is not sufficient unless CIT gives a proper finding. So this decision, a short decision, 3-paragraph judgment, but laid down important principles of the powers of the CIT while revising the assessment order. Last judgment with me is Vinubhai Mohanlal, where the compounding application was rejected. The issue was the meaning of first offense under the 2014 compounding guidelines. The issue was that in the particular case, the assessee had filed a late return for AY 1112, for which a show cause notice was issued by the department for initiating prosecution proceedings under 276CC. After the initiation of show cause notice, the assessee filed belated return for next year also, that is AY 2013-14, for which again a show cause notice was issued. The assessee went for compounding application for both the years. For AY 1112, it was accepted on the ground that it was a first offense. The return was filed before the show cause notice was issued by the department, and therefore the application was compounded. but the second year was rejected by the department on the ground that the offense has been committed after the show cause notice was issued for AY 2011-12, and the offense was delay in filing return of income for AY 13-14. So the compounding application was rejected. The assessee filed a writ petition, which was again rejected by the Gujarat High Court, against which the assessee came in before the Supreme Court. The Supreme Court has held that the offense was not committed at the time of filing the return of income. The offense was committed as soon as the due date for filing the return under 139(1) lapsed. So in the present case, that time elapsed much prior to the issuance of show cause notice, even for AY 11-12. So therefore, both the offences for 11-12 and 13-14 were committed prior to the show cause notice, and therefore both the offences will be considered as first offence, because as per the compounding outlines, the first offence means all the offences for any year but prior to issuance of show cause notice for prosecution. So accordingly, the Supreme Court has emphasized as to what is the date of offense. The date of offense is not when you actually file the return, but the date when the due date to file the return of income expires. And then again, while holding as above, the Supreme Court has also given an observation that compounding guidelines needs to be liberally construed. Depending upon the facts and circumstances of the case, the commissioner has always power to give a leeway to the strict interpretation and allow the compounding application, which must be liberally construed rather than doing a strict interpretation. So these were the few important ratio emanating from these decisions. Over to Amol.
Thank you, Gauravji. Sriramji, could you just give us the
Yes, I'll try to
your thoughts on the three judgments?
Yes. The first one I will want to discuss is about the judgment of self-drilling, which is clogging matters at the tribunal level. This is a judgment where the division bench of Supreme Court, because of conflicting views of both the judges, has referred the matter to the chief to form a larger bench. Broadly, the issue is Section 153 provides a time limit for conclusion of assessment. And generally, as the law now stands, an assessment is to be concluded within 12 months from the end of the assessment year. In case where transfer pricing is involved, 24 months from the end of the assessment year. 144C, which relates to the requirement of passing a draft assessment order in the case of a non-resident assessee, or where there is matters relating to non-resident, that is transfer pricing, etc., provides that the final assessment order has to be passed within 1 month from the end of the month in which the DRP order is received. Question before the courts is, which of the notwithstanding clause, one in Section 153C and the other in 144C, will override the other? The Bombay High Court in self-drilling and the Madras High Court in Roka Bathroom, subsequently the Bombay High Court in PayPal also held that Section 153C limitation is the outer time limit for passing any orders. 144C outer time limit is only for passing the orders within the timeline specified under 153C1. The first judgment in this was self-drilling, which was initially the Supreme Court said the judgment effectively stayed the operational order. Then came Roka Bathroom and subsequently the Bombay High Court in PayPal also. Now the matter has been referred to the larger bench of the Supreme Court. That's number one.
Thank you.
Second judgment that I want to highlight is the judgment of the Supreme Court in case of Vaibhav Goyal. It relates to income tax demand. What will happen to an income tax demand pursuant to settlement of disputes under the IBC? The same problem with the income tax department faced when BIFR was there is now again emerging now. The assessee in this case, or not, the resolution applicant in this case, had huge income tax demand, which was only shown as a contingent liability because the assessment was ongoing at the time when the resolution plan was processed and then upheld by the tribunal. After the resolution plan was approved, the income tax department issued demand notices and sought to recover it from the successful bidder. The resolution professional, or the person who was managing the affairs, moved a petition to the NCLT saying that recovery cannot be done because it is all covered in the NCLT proceedings. The application was dismissed by the NCLT and a cost was imposed on the applicant for moving such petitions. An appeal against that to the NCLAT was also dismissed. In appeal to the Supreme Court and SLP to the Supreme Court, it reiterated the principle of clean slates in case of IBC proceedings following SR and Ghanshyam Misra series of judgments held. It was the obligation of income tax authorities to place before the resolution provisional the case of all demands, whether fructified or not. If they have failed to do so, they cannot come back, even if it is statute reduced or queen's debt. This is what this judgment reiterates. The third judgment, the judgment in the case of National Cooperative Society. This is a society which is engaged in the business of providing various long-term finance to promote agriculture. Section 36(1)(7) provides a deduction for persons who are engaged in the business of providing long-term finance. A deduction of 40% of the profits that they make and they set aside in the reserve. But that is restricted to the 40% of the profit derived from the business of providing long-term finance. The assessee, in the course of its business, earned 3 other sources of income. First, being a dividend from the shares that it had subscribed to some of its borrowers. Second is interest that it had earned on bank deposits. Third, its service charges it had collected in relation to the Sugar Development Fund. The assessee claimed that these income is also eligible for the 40% deduction under 36(1)(7). The assessee relied upon various Supreme Court judgments which says that these types of income are incidental to its activities. The assessee is engaged in only one business which is provided in long-term finances. Therefore, these incomes should also be considered as arising from providing of long-term finances also, and relying upon Shane Steel, etc. The Supreme Court made a distinction between income from business and income derived from the business of providing long-term finance. The Supreme Court held all these 3 heads of income are in fact income from business, but are not income derived from the business of providing long-term finance, and denied the deduction to the assessee. And that's all I have on my end, sir. Open to the floor.
Thank you, Gaurav ji. Thank you, Sri Ramji. Prakash ji, now I'd request you to open the house and what all questions are there, the panelists will attempt to answer those.
Yes. We will start the question answer this one, sir. Although we know that we are running out of time, and I am also appreciate that Sriram sir has some problem here. Although there is a fog in Delhi, but I do not know how it is affected in Mumbai also. But yeah, Mumbai also been affected here. And however, may I request Richa ma'am to start the question?
Sure.
But before Richa ma'am starts, I have received some question on my WhatsApp here. I will read that question here, and this question goes on the root of the issue. On the first issue of the 44C, the question is that whether the new interpretation of the 44C will lead the issue of the attribution of profit into a P dispute of the which is totally a controversial issue, and the consequential question is also there whether it will lead to the TP adjustment also or not here, because the markup will also there, because where the cost plus P is there, how it has to be seen, whether the TP is there, how it has to be seen. And particularly the issue of attribution of profit was also always in debate issue here. Now the another debate is coming on to how to interpret the 44C. So this is the issue that I received through the WhatsApp. So before Richa ma'am starts discussion, I thought that I should share these issues here before the elite panel here.
Pannu sir, your thoughts on that before we...
I think let Sriram want to answer this.
Gaurav sir.
Okay, Gaurav, you want to say?
Yeah, sir. I think the question is right. Given the larger interpretation of the word attributable to given by the Supreme Court, the revenue would tend to extend that interpretation to even the cases of DTAAs as attribution to PE. So that certainly can be a issue which revenue can rake up. So the issue will be whether attribution can be for can there be a higher attribution of income to the PE or not, given the larger meaning of the word attributable to. So that debate will be there. That's my observation.
Well, okay, fine. As a question, it is all right. But you see, everything depends on in the context is what you are looking at. Now, for instance, what have the Supreme Court said? What they had only said is, the common sense logic is, when you say something attributable, it will also include something which is 100% attributable to you, which is the direct expense. So what is the difference? Attribution would have been that if something is 1% attributable, 2%, 3%, or 99%. 0%, obviously not linked to you. 100%, obviously attributable. So it does not change much. But yes, when it comes to understanding the meaning of the word attributable in some specific dispute of, even in the case of a PE attribution, they may take benefit. But then ultimately, what is it that they're trying to say? So each fact, to look at it as to why, I mean, normatively speaking, we'll have to look at those things at that time.
True. And ultimately, we will have to see on facts the nature of income.
And first of all, it should be an international transaction.
Right.
Right.
So,
right.
I mean, we'll cross the bridge. Everything, we need not fear anything.
True.
On that point.
Great.
Richa
Thank
ma'am,
you.
please.
So, Richa ma'am, please.
Yes, sir. So the first question is, does MX ruling also overrules other IT/AT rulings that allow deduction of marketing expenses, IT-related expenses, etc. under Section 37(1)?
So, yeah, I'll make an attempt first. I think Supreme Court has answered it in a way that the scope of head office expenditure is restricted. So they have restricted it to the expenses covered by clause ABCD. On bare reading of that, according to me, marketing expenditure or IT related expenditure is not falling. So if it is falling, it will be covered. If it is not falling, it will not be covered. So maybe I read a judgment on laboratory expenses incurred by head office, or a technical fee incurred by head office, technical know-how fee, a common technical know-how fee. Those expenses are not covered in the list of expenses. So as per the decision of Supreme Court, they will not be attributed and subject to the ceiling. So they will be outside the ambit of 44C. The normal principles of attribution, how you are allocating the expense, will prevail.
Actually, you're right. This is precisely why Supreme Court, in its paragraph in the end towards, they said that they have specifically referred to clause D of that subclause D of clause 4 of the explanation, where they say the executive and general administration expenses as may be prescribed. So one has to strictly go by the definition. Since they say it is exhaustive, we should go by the definition of what is covered by head office expenditure in the explanation there. It's only in that situations that the clause, section 44C would be attracted. So they're saying that first, if this is attracted, then only the clause A's limits will kick in. That's what.
Otherwise, normal allocation, how the assessee is doing, that will be tested on an independent basis. It will not be subject to any ceiling.
Yeah.
Ma'am, you go to the next question.
Yeah. So it's a comment and a question. Is it applicable only in cases where India branch does a third-party business in India and not in case of captive branches? Why would Indian branches not cross-charge such cost to the branch? Is it not that such cost when cross-charge to BO would be part of respective expense head? If we go by Supreme Court, that would mean there cannot be cross-charge beyond 44C limit. If foreign accounts are not verifiable, the proof of expenses claimed in India is maintained for verification. There are cases of cross-charge of even salaries of seconded employees. If non-verifiability is a reason, does it mean that allowed HO expenses when claimed within the limits will not require verification?
Sir, would you like to answer? According to me, everything will now fall into 44C, whether the expense is covered or uncovered. And whether it is branch, whether it is captive, whether it will not make any difference.
I really don't get the question. How does it talk of an head office expenditure in the meaning of the explanation? That's first thing. Because is it applicable only in cases where the India branch does a third-party business in India and not in the case of captive branches? Why would Indian branch not cross-charge such cost to the branch? No, of course, there was this judgment in Bombay also, they said so in one of the decisions, that head office expenditure, it was the nature of head office expenditure, but it was reimbursed by the branch as his own expenditure. So obviously, it comes out of 44C. If it's something which is incurred by the branch, it will go in its own assessment as an expenditure. Not in the nature of, so it has to be seen what is the nature. Does it fall in the definition of head office expenditure or not?
Yeah.
And incurred by the SSE outside India, please make sure. It has been incurred outside India. So those characteristics have to be met only then, because this this question has a lot of cross. I mean, if you're incurring in India, then obviously it's not the question. It's not.
Yes, it's not covered under 44C.
Therefore, you have to look at how the entire thing is prefaced. It says head of expenditure means executive and general administrative expenditure incurred by the SSE outside India, including expenditure incurred by way of so and so, so and so, so and so. So it has to be of executive nature, general administration nature, incurred outside India. First qualify, yes. You have to qualify. These are qualifying expenditures. Okay.
The next question is, in the case of Pride case, had there been only interest on refund income in the intervening period and no evidence of communication with customer, how do you view that if later, after say 5 years, the foreign company decides to set up P in India and do the business, will that allow such unclaimed expenses at that time?
I don't think it is possible because income tax as a matter, the scheme provides for taxation for every year. And unfortunately, we don't have the process of carry backward of losses. Okay. So if there is no communication, no business carried on, it might be difficult for subsequent PE to claim the loss set off.
It will be a factual issue whether you can say that the SSE was carrying on business or not, and there was temporary lull or there was complete cessation. So it will be factually driven. One cannot answer. It cannot be generalized.
Correct. So we have to see. We must understand the concept. The concept is it a lull of? Is it a case of a lull in business or a cessation of business and restarting at a certain point of time?
Yes.
So if in your example, if you choose to obviously take that claim, you will have to demonstrate there was only lull in business and not cessation of business. Yes. How do you prove it? Your facts don't say so. But then the onus will be on you to prove. So therefore, be guided by that kind of a concept. It is not necessarily, a question cannot be in absolute terms answered that after 5 years you do this. No, you have to demonstrate it was mere lull and not cessation of business. How you are able to do that? In that case, they had correspondence. They were in touch with the ONGC. Was ONGC yes, in India for seconding their personnel. They selected people and gave it to them. They had the charges for it. They were bidding. Obviously, they were also in the business of exploration of oil. And oil exploration is not a daily affair. The projects are for a long gestation period. So you bid in 1 year, you may get it in the next year. Then you may start the business. Actually, but then each business is different. Supposing you're in a business of trading. If you don't trade for X number of years, you obviously can't be saying that there's a lull in business. It's a cessation of business. So therefore, you have to weigh all this. The concept what has to be taken away from the judgment is that you have to establish, is it a case of a lull in business or cessation of business and restarting thereafter?
So there is one last question if I can take.
Yeah, sure.
Yeah. So Article 7, Para 3 of India USA talks about allowance of expenses by the assessee for its P in India, but Section 44C subjects to limit of domestic law. But there is one more Article 26, which is non-discriminatory clause. Had been the assessee not a non-resident, he would be allowed such expenditure without any restriction. So I wanted to ask whether Article 26 comes into play into this or not. Hello?
Sriram, you want to say something on this?
Yes, sir. I remember reading some other clause in the treaty itself, which says the restriction placed in 7.3 will not apply to restrictions of the sort specified in 44C. I'm trying to take it out. There is some other clause, madam, which says that the restriction in 7.3 will not apply to restriction on head office expenses.
So I think that's all were the questions.
I think there was some tribunal decision vis-a-vis the non-discrimination 26. Gaurav, you remember that? Anything?
No, not really, sir. Right? No.
There was some tribunal decision, I think, authored by Mr. Pramod Kumar on branch expenses in India vis-a-vis foreign country.
So basically, the question is whether Article 226 can apply to Article 7.3 and therefore not restricting the allowability to the ceiling of 44C, because 44C is not applicable to a resident in India. One would need to check that.
Anything more, ma'am?
No, sir. I think that's all.
Okay. No. I think that we have already suit over the time here, and before I request Saurabh Bhattacharya to give a special vote of thanks. I must say one more thing here. Today, I just received the message from Sanjeev sir that Prakash ji, you are taking so many judgments for the discussion, and there is a more than we have discussed around 6 judgment in detail and around 6 judgment in short here. I think that this idea that has come to us because today ISRO rocket Bahubali has lifted the heaviest satellite and placed into the lower orbit circle today here. It is the record that which India has done here. So when the ISRO was doing this work here, I thought that let's do the same work here also. And since it is a year-end issue here, so try to discuss more judgment here. And so that we selected here around 12 judgment. I know that it was a heavy task for all the learned speaker and the panel and the chair sir and the moderator also. But it was a year-end exercise here. So therefore, we have selected that number of judgment, 12 number of judgment. Sanjeev sir, we never try to discuss the whole judgment in that part here since it was a recapitulation only. So we have tried to cover this number of judgment here. So hand over to hand over to Saurabh sir for hearty vote of thanks here.
Yeah. So if the altruistic.
You are in the mute, sir. Yes. You are in the mute, Saurabh.
So if the altruistic motive of Chamber of Tax Consultants to spread tax knowledge among the tax fraternity is the guiding principle, then I should say kudos to the speakers over here who have taken enormous pain in preparing for the heavy load of 12 cases, and that too discussing in all possible details, even answering queries from the audience. So that goes to show the extent of preparation they had been through to prepare for these cases. So kudos to both Sriramji and Gauravji. And as usual, under the watchful and the compassionate and the guiding eyes of Pannu sir, which has always been helpful in spreading the flame of knowledge that CTC stands for. So, with thanks to the panelists, Gauravji, Sriramji, Pannu sir, and also to the organizers, including the lead Prakashji, Richa.
Mr. Moderator was doing a lot of work here.
His good, enormous contribution over here also.
I was in touch with I was in touch with Amolji, and I was just pumping that what we are doing on everything is here.
No, I was on a holiday, so Prakashji, I took a deserved leave and just deflecting the questions, not contributing much.
But even on a holiday, you took the trouble of moderating, and then that was, of course, very much appreciable. So thanks to all of you. And Prakashji, taking cues from Sanjeev's suggestion, suggests that a follow-up session on this be again done, because many aspects have been raised by queries, and as the presenters as well as Pannu Sahab has spoken on things that need a bit of more deliberation, maybe a follow-up session would be in order.
Yes, and Sridham, that about that Article 26, I think what you're looking for.
Yes,
I think 7.3 itself would have an answer,
yes, sir,
because
yes,
it says the subject to the provisions of the tax law of the particular
sir.
state where P is liquidated.
Yes,
So
7.3.
I mean, once that is there, then possibly that has to be seen in that light.
Yes, sir.
Isn't it? That's what you were looking for, I think.
That's what I was looking for. 7.3.
But 7.3 has that words. My memory doesn't fail me, I don't have that spirit with me. Is subject to the provisions of the particular state where the P is located.
Yes.
If those restrictions are there, then that will answer that. Perhaps will have to be factored into.
Yes.
Yes.
Yeah. Before we close here, I'd just like to mention that next year, from the 6th onwards, we are starting a series of webinar where we will discuss study the comparative between the Income Tax Act 1961 and the Income Tax Act 2025. It was a comparative study. Will start from the 6th of January, and that will again 5:30 to 7:30, and it will take place on every Tuesday till the time in January, and there will be mid lull season, what we have discussed, that will be in during the budget, where we will discuss the budget part, and after that it will continue, because we have to cover many aspects of this part here, and we are trying to cover this new law in two or three manners here. We are trying to understand what are the changes, what are the implication of the changes, what are the judgment that will remain valid after the changes or not remaining valid after the changes here, how the word has been changed here, like notwithstanding word has been changed to a with, irrespective of, what is the implication of that part here. When the proviso has been changed to a new section, how to understand the proviso. There is no more explanation right now how to understand the explanation, what we used to learn from the GP Singh book and like this ones here. So now in 2026, we will all become a student, because the Income Tax Act 2026 will be totally new for us. 25 will be new for us. So let's try to become again a student in the new year. With this, I'm thankful to all the panel member, respected chairman sir, respected moderator, for sparing your valuable time and valuable thought and doing so much of labor for this purpose here. Okay, Sriram sir, now you will get the 18% refund on the air purifier also, because today Delhi High Court has said that why you have kept the air purifier 18% block, if the smog is so high, reduce into a medical devices here, so that the 5% rate should be applicable pan India here. So please purchase the air purifier Bombay also. With this, I'm really thankful to all, sir.
Thank you
Thank you,
very much.
Prakash ji.
Thank you.
Thank you, Pannu sir. Thank you for your insight. Thank you.
Thank you, and all the very best to everybody. Thank you.
Thank you.
Thank you.